how to protect yourself if the market continues to go down, we have Rich Ilczyszyn from iiTrader. Hello, Rich. Great to have you.
Thanks for having me. Always a pleasure to be here at Kitco.
Okay, Rich, let's start off. How can investors protect themselves if the market continues to drop?
Well, listen, gold is actually trading as a currency. We probably all have realized that as of late. And really, this sell-off in gold actually started about a year ago with the Japanese yen falling, boosting dollar prices. We're at a pivotal spot right here in the gold, currently trading at around $13.85, give or take. The recent low and the big drop, a couple of months ago, that $300 drop down to $13.25 is your base of support. Anyone who has physical gold right now should probably consider an insurance policy protecting your downside risk. If we break $13.25, a lot of analysts, not just me, but a lot of other folks on the street, people that trade gold for a living, are expecting gold to break at least another $100.
In your last interview, Rich, you mentioned using puts in order to hedge against downside risk. At these price levels, how are you using this strategy?
We would start looking to add puts from that 1320 level, which is support, and below, to protect your downside risk. This isn't a strategy to actually make money, although you could. It's actually to mitigate risk. What do I mean by that? Each contract that we trade at the CME Group is 100 ounces. So if you've got 100 ounces that's in the market at risk and it's physical, you don't want to have to trade the market. So you don't want to have to get out probably at the worst possible time, and at the worst possible time when it's going back up. So keep your physical gold, just put a little bit of an insurance policy on it. We have contracts that go out 30 days, 60 days, 3 months, all the way up to 1 to 2, 3 years you can protect your position. The further you go out, the more expensive the options are because of the time value. But I would say now's the time to hedge because we're again below $1,400, and if the equities make a new high, and the dollar rebounds a little bit, that could put more pressure short-term on gold, potentially breaking down. So what I would tell anybody is that why not go out for the next 30 to 60 days, buy puts, and if the market breaks your put strike price, you're totally hedged. In other words, you're neutral. So gold could fall from $13.20 or $25 if you have those puts on to $1,100. The money that you put into those puts, depending on how long you go out, covers the loss on the physical side of gold. So this is not really a trading strategy, it's a hedging strategy.
Okay, Rich, if you have an investor who's looking to protect themselves from this downside risk, what's the initial investment they need? Tell us a bit more about the contract specifics.
Because futures and options on futures are a levered product, it's great. Each contract is 100 ounces. So let's say that right now you could probably go out 30 days, give or take, and pay $600 for those 1,300 or 1,320 puts. That's going to give you 30 days of protection. If you wanted to go out a little bit further, you probably $100 to $200 more than that. So it depends on the volatility of the market conditions currently, but also the time value of the option. But each contract you buy covers 100 ounces. So if you've got 200 ounces, that's a lot of money if the market continues to fall another $100 to $200. This way you can mitigate your risk, take the variable cost, and lock it in for yourself. And simply, when the market goes up, you take off those hedges again, and the market resumes its uptrend.
Finally, Rich, let's wrap up. Give us your support and resistance levels for gold.
Well, the line in the sand on the downside certainly is going to be $13.25. Perhaps on the upside, $15.25. If you take last year's range and recent history, we've been at about a $300 range. I would tighten that up a little bit as we get into this consolidation phase, potentially. And right now, the two areas you got to watch are going to be $15.25 and $13.25. The bulls are going to want to see strong closes consistently above $14.85, which was the recent low, recent high from the low. We get above that, perhaps the bulls take command. But really, I think you have to watch a couple of things. The Japanese yen, the Japanese stock market, our stock market, of course, in the dollar. Now, if equities continue to make new highs and the dollar remains relatively strong, that's going to be more headwind for that gold short term. This could even be a sideways trade for another 1 to 2 years.
Rich, thanks so much for being with us.
Anytime. Thank you.
Thank you for watching this edition of Kitco News.